Hi there. Welcome to Raising Capital. Raising Capital is a Skillshare class about raising entrepreneurial capital for your new startup or venture. My name is Scott Hartley and I'm a venture capitalist. I spent a number of years at a Silicon Valley, Sand Hill Road venture firm, working with hundreds and hundreds of startups on raising capital for their new ventures. Prior to that, I spent time at a number of Silicon Valley companies like Google and Facebook. Today, we're going to be talking about the funding landscape, determining your capital needs, how does an investor think, how to build an investor pitch deck, thinking about market size, not just from the top down, but also from the bottom up, how to think about your company's valuation, and then how to articulate that valuation to the investors that you work with. So to get started, we're going to talk about the funding landscape. This might seem basic, but it's very important to understand the context in which investors are placed and how you think about approaching the right scale and stage investor given your startup's traction. So the capital pipeline consists of what I like to call the 4 different stages. So first there's bootstrapping. This is just, friends and family. This is credit cards. This is bank accounts. This is asking your friend to help capitalize your business. This is really sort of the very basic first step. The second is incubators and accelerators. We've seen a number of incubators come out of places like Y Combinator. We've also seen shared workspaces and shared desk rentals. They come in all shapes and sizes, but this is sort of the second stage. The third I like to call angel capital. Angel capital consists typically of private wealthy individuals who are making angel investments. And the fourth stage is really institutional capital. So institutional capital means that it's a formal fund. The fund is raised from third parties called limited partners, and they're subject to slightly more constraints than angels are. So we'll walk through these 4. So bootstrapping, like I mentioned, this is the true scrappy entrepreneurship. This is where you're working off your credit card, where you're scrapping together a bank account, where you're asking your friends and family to support you. This is typically the very basic prototype stage, where you're just trying to get a minimum viable product out the door, and you're trying to figure out if this is an idea worth pursuing further. Incubators and accelerators are really in vogue these days. They come in all shapes and sizes. They come from shared workspaces to mentorship programs to pretty rigorous boot camps where you spend weeks and weeks in-house in a place, oftentimes for an amount of capital that's taking a small equity stake in your business. Angel capital, like I mentioned, are typically wealthy individuals. They're often quote unquote smart money because they're entrepreneurs who have seen successful exits. They could be wealthy individuals out of other sectors, but typically in tech, we find that they're entrepreneurs who have seen great exits in companies that they've created. So they can be smart first investors to help kind of build into how to approach the market, how to build your first prototype. And they're not institutional because they typically are investing their own money. These guys can be found on places like AngelList or even Kickstarter. And they're investing out of their own bank accounts, so they typically don't have as many constraints around the sector or the stage that they're interested in investing in. The stage typically is early because it's smaller amounts of money, but they typically are more agnostic to the sector. So you might be able to find the right sort of angel capital to help you sort of get off the ground once you've got your minimum viable product and basic prototype. Institutional capital are formal funds that raise pretty large amounts of money from what they call limited partners. Now, limited partners are typically pension funds, university endowments, or large pools of capital. Those limited partners typically have a number of different investments. They put some of it in stocks, they put some of it in bonds, and they put some of their money in what they call alternative investments. Venture capital, private equity, these are forms of alternative investments. So institutional capital funds, venture firms, for example, are basically raising money from limited partners. So typically pension funds or university endowments. Funds typically run from about $50 million to about $1 billion US currency. And they typically invest from Series A all the way through initial public offering or until a company reaches the stage of public market where the stocks are listed on something like NASDAQ or the New York Stock Exchange. So the types of institutional capital really run from seed capital to venture capital to formal private equity. Seed capital, now we're still talking about institutional capital. So we've gone through bootstrapping, we've gone through friends and family, we've gone through angel capital, which is just private wealthy individuals who are investing. Seed capital are typically smaller funds. These are institutional funds that have raised money from limited partners. They typically are smaller in that they're probably 50 million or under. And they typically write the first institutional check, meaning that check is usually between about 250,000 up through about $1 million. These are rough estimates, but this is sort of the ballpark where seed firms are playing. The second type of institutional capital is really formal venture capital. Now, seed capital is certainly a type of venture capital. Private equity can be a type of venture capital, but I think for all intents and purposes, what people traditionally reference as venture capital are institutional funds that invest in early stage startups, and those funds are typically from 50 to 100 million up through about $1 billion in size. And now these funds are investing some of the earliest checks into a startup, usually a Series A through sort of growth equity. This is before an initial public offering. This is all private investment. And those check sizes are typically from about 3 million up through perhaps $50 million. Now, beyond venture capital, there is an area of investment called private equity. Venture capital is really a subset of private equity. It's typically very, very large VC. It's beyond the growth equity stages. It's where investments are made more around financial metrics than around team and market potential. So those are some of the big differentiators between the capital pipeline. So now as your homework, I would encourage you to think about your company, where you are in the process. Where do you fit into the capital pipeline? If you're finishing up your beta or your prototype, you're what we would call, the seed stage. If you found your product market fit, and you've raised some basic money from friends and family, maybe from some angels, you're potentially at the stage where you could go out for Series A and start talking to formal institutional funds, whether at the seed level or at the venture capital more Series A level. So this is your homework for lesson 1, and take a little breather, and we'll welcome you back shortly. Thanks.